dividends. Buy a share in a business and it's seemingly free income that comes along with it. While dividends come in all shapes and sizes, there are a handful of businesses who are in a class above the rest. These are the dividend aristocrats. And today, I'm discussing 3 that you can rely on for income and impressive long-term growth. These have stood the test of time and will continue to stand that test for years to come. Welcome to The Quality Investor. Today, I'm reviewing 3 incredible businesses that you can add to your portfolio and reap those rewards for a very long time. I've talked about dividends many times on this channel as a way to boost income and returns. But I've also discussed why not all dividends are created equal. See the video linked in the description. Some dividends masquerade as great yields, but the fundamentals behind those businesses are on the downswing. To achieve that, we need growing dividends, which the aristocrats have proven, but also capital growth. An increasing dividend, while the share price languishes, is a dividend that may get cut. See my other video of my favorite whipping boy, Walgreens, ticker WBA. And the last thing that we want is a cut to our income, especially if we rely on it. Before we get into it, make sure to hit that like button below and subscribe to the channel to stay up to date on quality businesses in the market. The 3 businesses that I'm about to show you are, in my opinion, the best combination of dividend growth and offer the best long-term growth option. I personally prioritize growth over dividends because growth, especially free cash flow growth, is the catalyst for everything else. Without real organic growth, a business stagnates at best or declines at worst. Again, see Walgreens. And as for stagnating businesses, let's check out this list. Currently, there are 67 dividend aristocrats, with 2 more set to be added in 2024. Here, I'm showing an example of 5 dividend aristocrats that are very well-known names, yet have not returned nearly what the S&P 500 has done. These are Colgate-Palmolive, Clorox, Coca-Cola, 3M, and Johnson & Johnson. You can see here on a 10-year annualized basis, these have returned well below what the S&P 500 has returned. In fact, the S&P 500 has returned about double these 5 particular stocks, 12.7 for the S&P versus 6.2 for these 5. So when thinking about dividend aristocrats for income, one must choose wisely. And to demonstrate that even further, look at this ETF, which is the ProShares S&P 500 Dividend Aristocrats Fund. This is a fund that tracks all S&P 500 Dividend Aristocrats. And you can see in a 5-year basis, it has returned 44.8%. Contrast that, however, with the S&P 500, and you can see the S&P has returned almost 80% over those same 5 years. So like I said, investing purely for dividends, you might be leaving some money on the table. The first on our list today is S&P Global, ticker SPGI. A market leader in credit ratings, indexing, and market data, this aristocrat has a wide economic moat. With 52 years of dividend increases, this business continues to have a long runway of growth as indexing and data analytics become ever more important. You can see the 20-year compound annual growth rate for S&P is nearly 10%. And over that same period, the free cash flow payout percentage is at 36%. Free cash flow payout percentage, of course, being how much is used for dividends. You can see that comparison down here. The green bar is our free cash flow growth, and you can see it's far outpacing the dividends paid. And on a per share basis, they've seen steady growth over the last 15 years on their free cash flow, and you can see the nice growth here in their dividend per share. The yield has come down quite a bit, but that's due to their outstanding share price growth. While at the same time, the year-over-year dividend growth has steadily increased. S&P Global is currently trading at $431.59, which is down about 2% year to date. But with a 5-year earnings per share growth estimate at nearly 13%, S&P Global should enjoy share price appreciation along with great dividend growth for years to come. Next on the list is Caterpillar, ticker CAT, and it is effectively a duopoly along with Deere. With 29 consecutive years of dividend increases, this maker of construction and resource extraction equipment benefits from high barriers to entry. Demand for resources and infrastructure will only grow in the future as human populations continue to grow, and Caterpillar will be there with the equipment necessary. I would say Caterpillar is a bit more cyclical. You can see the year-over-year dividend growth here is a lot of peaks and valleys. However, in lean years, they tend to fortify their balance sheet. And you can see they've had very nice free cash flow growth over the last 10 years or so, far outpacing their dividend growth. You can see that illustrated up here as the free cash flow payout percentage has steadily declined over the last 10 years. They also averaged over 10% compound annual growth rate over the last 20 years. However, that yield has come down a little bit due to their share price growth. However, Caterpillar remains the market leader in construction equipment and should be for years to come, and especially as more and more infrastructure is required for our growing United States of America. Caterpillar is currently trading at $379.30. And year to date, they've been very hot, returning nearly 30%. And as Caterpillar continues to grow their earnings and revenue with the 5-year earnings per share estimate at nearly 13%, Caterpillar should continue to grow not only their dividend, but also their share return. Finally, we have Fastenal, ticker FAST. This is the newest dividend aristocrat, achieving that status just this year, having now grown their dividend for 25 consecutive years. Fastenal is a growth machine. While Caterpillar provides the heavy equipment for building, Fastenal provides the nuts and bolts to put it all together. A simple yet high demand and high growth business. You can see they have easily averaged well above 10% for their compound annual growth rate over the last 1 to 20 years for their dividend. And while their free cash flow payout percentage may seem a bit high, but this is due to their commitment to returning capital to shareholders. You can see down here on free cash flow versus dividends paid that their dividend increases correlate highly with their free cash flow growth. And because they can generate such good free cash flow growth, they've been able to maintain that very high 10+% per year, year-over-year growth. Fastenal is currently trading at $76.61 and has generated a 19% return year to date. While their growth is expected to be a little bit slower than the other two, 6.3% for the 5-year earnings per share growth estimate, their growth is very steady and predictable. Looking here at their 5-year chart, you can see their only real drawdowns are when the economy overall is not as hot. This makes Fastenal a great addition to any portfolio. That wraps up our discussion on the 3 current dividend aristocrats, but make sure to check out the video on the bottom left of the screen here for my picks of 3 future dividend aristocrats. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.